Do you have a small account and are you thinking about selling put options? Because in this video, I'm going to react to Tastytrade and their video, how to sell put options in a small trading account. They have done some research and I wanted to react to it because I think that there are some really good golden nuggets. So without waiting, let's get into it.
On what else you got at 9 o'clock. We know from past studies that put selling strategy outperforms other traditional strategies. We're gonna, like I said, we're gonna expand on that a lot in the coming segment. And it's not that we're just sitting here we're bearish on the market talking about put selling strategies. I know that seems like they're, that's a little almost counterintuitive or almost hypocritical to a certain extent, but it's not. But that's not
bearish on the market.
We're just throwing out examples because in order for us to get everybody to the next level, this stuff has to be kind of almost second nature.
Sure.
And you have to believe it. The one thing we do, I think, better than anybody else is that we stay on a subject long enough for everyone to really understand, kind of all the guts. Like most of our listeners can recite the numbers, and that's powerful.
Yeah, so just on that note, on what they're writing on the screen right now, like saying that selling put options basically outperforms buying and hold strategies, it obviously depends on how much capital you're deploying when you sell put options. But what Tom says when it comes to staying on a subject long enough so everyone can actually understand it, I think that's really one of the main strengths of Tastytrade is that they've done so many backtests, so many studies on so many different strategies. It's really hard in the end not to see why they're doing what they're doing because they're putting out so much content, so much studies. I think it really gives a good picture of what is good, what is bad, why are they doing what they're doing, and I really love the fact that they're putting so much studies.
Right. So we know from past studies that, we already did that one here. With the advantage of only having to put up roughly 20% of the underlying, we can take advantage of this strategy in accounts with limited capital as well. We wanted to look at specifically to see if a particular strike was better than another from a buying power reduction standpoint.
So what they're mentioning here when they say that you only have to put roughly 20% of the underlying, what they mean there is that when you sell a put options, you don't have to, for example, put the stock price times 100 as buying power. Your buying power is basically going to be defined as roughly around 20% of the underlying, and that's basically what it is. So that's quite interesting, especially when you have a small account to basically sell put options because you don't have to put as much capital on the table as if you were, for example, buying 100 shares of the stock. After that, and that's really, really important to mention that it's not because you can that you necessarily should. When you have a small account, you should really be careful, and actually with any account, you should really be careful about your portfolio allocation. And it's not necessarily because you don't have to put a lot of capital on the table so as to put a trade on that you should necessarily do it. And the reason I'm saying this is that it's very easy to really over allocate yourself when you're selling options. So just be careful on this.
Because the email that we get the most with respect to smaller accounts is, number one, I'm trading in an IRA account, so I have limited capital to use. Or number two, I can only trade smaller stocks because I have certain permissioning limitations, all this kind of stuff. So we're just said, okay, let us hammer down to the tightest specific bit of information so that if you ever need to make the case or whatever it is, you can do that.
Correct.
The further out of the money we sell a put, the higher the probability of profit, but the smaller the credit received. Assuming that we're bullish, is it better to sell a closer at the money put to collect a larger credit and not have the room to the downside? And is selling puts a viable strategy for smaller accounts? So the number one email question is not so much is it a viable strategy, but is it better to collect a bigger credit and have a lower probability of success, or is it better to have a smaller credit and a higher probability of success? And we struggle with the same thing, so we stick around that 30-35% level.
Correct.
That's really interesting what they're posing as a problematic here, because obviously when you go further out the money, you're going to have a higher probability of profit, but you're going to have a smaller reward. And that's always what I talk about in most of my videos, that balance of probability of profit and reward. If you want to have a high probability of profit, fair enough, but you won't earn a lot, and that's normal. But if you want to have a bigger credit and so earn more money when you win, then your probability of profit profit, you will have to decrease it. And personally, I tend to sell options around like the 20 delta, 25 delta. I feel it's a good balance for me. But what's really important to mention, even before looking at their numbers, is that I can tell you that there's no right or wrong answer. It depends really on what you want. If you want to earn more money when you win, then maybe go closer to the at-the-money strikes when you sell options. But if you want to have maybe less volatility in terms of P&L and also have a higher probability of profit, then maybe selling options that are further out the money is better for you.
Okay, let's go to the next slide. To test this, we looked at 4 years of SPY options from 2009 to 2012. Okay, we understand it's a bull market, but that's all we have to work with right now. Each expiration cycle, we sold the one standard deviation put nearest to 84% out of the money, and then we sold the nearest out of the money put. So essentially just something like, let's call it just like an at the money, just one strike out of the money. We let them both expire to cash each cycle. Let's go next slide.
Just before we go into the results of the study, they mentioned that it was from 2009 to 2012. So that's important to mention here the limitation of that study, meaning that it's a bull market. So obviously, you're going to have great numbers when you sell put options because you're bullish. So when you sell a put option, if the market is going up, you're going to make money. If the market is going down, then you're not going to make money. You're going to lose money. And that would have been interesting to actually see from maybe 2008 to 2012. So the period of the crash, of the financial crash. So we could have had the financial crash included in that study, because in my opinion, it's a lot more interesting to see how a strategy is performing during bad times compared to how it performs during good times. Because obviously, as you know, during a bull market, everyone is a genius.
So it makes sense that the one standard deviation put had more winners. In fact, the one standard deviation put 49 winners, and the two standard deviation, and the at the money put 41 winners. And how many instances is that? I forgot. What was the number of years? Let's check.
4 years. We looked at 4 years of SPY options from 2009 to 2012, each expiration cycle.
4 years. I'm just trying to think. It has to be it has to be longer than 4 years.
What's really interesting here is that you can see that when you sell a one standard deviation put, you have a percentage of winners that is 94%, when in theory, it should be around 84%. So we can ask ourselves why? Well, there are several reasons why. First of all, as the market is continuously going up after a crash, obviously, you're going to have less occurrences where your puts are being tested. But also, you're going to have another factor coming in. The implied volatility tends to be overstated. So when you sell a put, and let's say you have an 84% probability of profit, it's not uncommon to see that your actual win rate is going to be higher than the theoretical one. So in theory, they should have an 84% probability of profit, but as the implied volatility is overstated, then it's normal to see a win rate that is actually higher compared to the theoretical one. And regarding the P&L, I think that's really interesting because you can see that obviously when you go further out the money, you have a higher probability of profit, but you earn less money. That's what I was saying before. You cannot have like the best of both worlds. Otherwise, trading would be a bit too easy. But what's really, really important to mention here, and that's something that I discovered myself when I started selling options, you can see that you have on the last line the standard deviations of returns. So that's a fancy word to basically say what is the volatility of your P&L. What we can see is that when you sell a one standard deviation put, your P&L volatility is way smaller compared to the volatility of someone who would sell an at the money put, meaning that you're not going to have as much volatility in your P&L when you sell a one standard deviation put, when you sell a further at the money put, compared to someone who would go closer to the at the money strikes. And that's personally something that I've noticed myself. I tend to sell options around the 20-25 delta, and I've been amazed when I started selling options to see how low volatility my P&L had. And that's actually quite nice to see that having a 1% change in your P&L in your account on a single day is actually a big day for me. And obviously when you have a crash, that changes a lot. I mean, if you go, for example, through 2020 or through 2009, you're going to have some big volatility even though you have sold some at the money puts. But on a regular basis, in normal times, you're not going to have that much volatility. So that's quite interesting that they include that.
Because there's 49 instances. 12 times 4 is 48. So it's a little bit longer, but whatever. We'll check it out. Just ask those guys to just IM us and tell us the exact number of cases there were. Percent winners, 94% winners. Well, we should be able to figure that out right there. It's got to be 50, whatever it is, 50 something small. Percent winners, 94 and a one standard deviation moved out. Remember, this is a bull market. And at the money puts 79%. But here's the difference. Look at the P&L, Tony. $1,878 by having the higher probability of success, and
which it did work out that way too.
okay, so yeah, it's just more instances, but it worked out that way. And the standard deviation of returns 456 to 1407. This I felt was really cool information.
Sure.
Because if I'm a smaller trader and I'm trying to deal with the issue of commissions, and I'm trying to deal with like the earlier emailer had, I'm trying to deal with the issue of transaction fees, commissions, and also trying to decide, so the at the money put, let's just say it's the nearest.
It was 4 years, but it included the first 4 months of 2013.
Okay, so it's 52.
Yes.
Okay. If I'm looking at this and I'm thinking to myself, why through all the years have we been picking the number between 30 and 35%? Now I've validated it.
Right.
Because even though
finally we get validated on something we've been proved wrong a couple of times.
But now this validates it, because the nearest out of the money put, let's just say that has somewhere between 50 and 60%. And the one standard deviation push is 84%. We've been doing something around 65 to 75 in that range.
Yep.
And I kind of think that that's probably the sweet spot. And sometimes you don't get to choose. But from one out of the money strike, from the nearest out of the money strike, which obviously works better in a bull market, to further out to whatever that is, 3 or 4 out of the money strikes, look at the numbers. Well, I had no idea that it's common sense that your percent winners is going to be much higher one standard deviation.
Sure.
But the P&L difference and the standard deviation of returns is extraordinary.
It's almost 3 times.
They mentioned transactions fees and commissions just before and trying to deal with those. So I think that this video dates from like 2012, 13 or so. Back in the days, the commissions were much higher. It was around like $10 per contract, if I remember well. So I mean, it's not even like comparable to now. Now it's only like $1 per contract. Since Robinhood came on the market, as much as we can hate on Robinhood or whatever, they absolutely broke the commission structure of all the brokers. So that's an amazing thing that happened. Like now for retail traders, commissions, I'm not going to say that you don't even need to think about them. You don't need to think about them as much as you would have needed to think about them back in the days. Like when you have to pay $20 or $30 worth of commissions for just one trade, you really think hard about which trade you're going to take. Nowadays, it's not even comparable.
So the argument that we make all the time that you can, sometimes people say, well, it's like picking up nickels in front of a steamroller. They use that same line constantly.
Right.
And it didn't prove out to be that way, but it did prove out that you're picking up nickels. All right. I'm going to come back to this slide. Let's go next one.
This I disagree though, like because when you go, for example, to 2020, well, obviously, it was in 2013, so they couldn't know what was going to happen, but they've had crash before. So, like the picking up pennies in front of a steamroller, I wouldn't say that this is exactly true, but, in theory, that's what it is. Like you're going to have small winners after small winners, and then boom, a big loss. And that's very logic. Someone who would buy options would tend to have small losers and then have a big winner. Someone who sells options tends to have small winners and then a big loser. That's just, the other side of the balance.
So the number of winning trades executed, what was predicted by probabilities, 84% and 55% for the at the money put. But part of this is due to our data, which was from a period of consistent rallies. Longer data sets would likely show probabilities of profit closer to predicted values. So what our own team is suggesting is that the 90... Go back one slide, Linda, for a second.
The 94% and the 79%.
The 94% should be closer to 85, and the 79% maybe closer to, I think it's a little higher than 55. I think it should be around 60. And that's what our own team's even suggesting. But they're saying here that due to that strong bull market,
the results are, though.
But they are what they are. And what's cool about this is, let's just say we went into a prolonged bear market, just for whatever reason. You now have bullets. You now have ammo of kind of where your short calls are going to be.
Right.
If you use the same strategy, but on the call side. And if we think we make a very strong bottom at some point in the future, we can go back and reach to this, which again, if you're trying to build up equity in a tasty bite-sized account, this is a very interesting way to support the thesis, the argument for having some of that risk on.
Yeah. Talk about maximizing returns.
Let's go next slide. So, just go back for 1 second, just a quick second. So I just want to repeat this. So again, remember, longer data sets will likely show probabilities of profit closer to predicted values. But before we go to the next one, remember what it's like to sell premium. There's always this little bit of extra edge. Every time we do a study, no matter what we do, the edge always proves out that our performance is greater than whatever the expectation is. The implied volatility has a tendency to overstate actual volatility, and that is the key. Let's go next slide.
That's what I just said before. Like, not only in that study, they were in a bull market. So, it's normal to see that the actual win rate was going to exceed what was the theoretical win rate. But on top of that, because of implied volatility tends to be overstated, so the premium tends to be too expensive compared to what it's actually worth, then in that case, you make more money. And you can see that with what we call the skew. After the crash of 87, then, puts started to become more expensive on a regular basis because people were hedging their long stock portfolio, and that had an effect on puts being just more expensive, and that's just now what happens on a regular basis. And it's like buying an insurance. If you buy an insurance, you know that you're paying for something that is likely not to happen, but you do it because if it happens, you're going to be covered and you're not going to lose money. And when you sell an option, you basically take the other side of that insurance. You're selling the insurance to someone who wants to protect himself.
The proportion of potential reward and the variance of that reward is about the same. The capital requirement of the at-the-money put is also proportionally higher than that of the one standard deviation put by approximately, in this case, 1,600 to 650.
That's important to understand, and I want to really mention this. I just cut them off. When you have a greater volatility in the P&L, let's say that you sell an at-the-money put, and theoretically, you're going to have a greater volatility in the P&L. Because we know that there's going to be a greater volatility in the P&L, the buying power required to put the position will also become greater. So that's why you're going to see that, for example, the buying power for your positions is going to move, is that as they, for example, get closer to the at-the-money strikes, we expect, for example, a bigger volatility in the P&L, and so you're going to have your buying power that is going to expand or decrease depending on how at the money or how out the money you're going.
Because, the SPY is a big product. Remember, the way you figure out the amount of capital required, you take your short strike, and then you add the credit back to that short strike, and you take about 18% of that, and that's probably 17 to 18% is generally speaking the number.
Very good.
Let's go next slide. Selling puts was effective even without management and entering the trade regardless of implied volatility. We have shown that managing winners and selling premium when the implied volatility is above 50% can vastly improve ROC and probability of success. So what a future study is going to include is, what if we only picked the spots when implied volatility exceeded the 50th percentile? What would happen then?
Right, now you're putting it all together.
How much risk would we take off the table, and how much would we improve our return on capital and our probability of success under better circumstances? We sold bottoms.
And you're saying
here.
that because we've done market measures where when the IV percentile is above the 50% in today's option statistics, that our results are significantly better.
And right, so what we didn't do here was we didn't sort it by IV percentile.
Right.
If we had sorted it by IV percentile, we think we would have done better, and which is why we're encouraging you to tune in daily for all this stuff, because it's so valuable how it all connects.
Sure.
Let's go to the last slide. While we did generate a greater return selling the at-the-money put 3.14 times more, we also saw a greater variance in P&L, 3.08 times greater. While both strikes proved profitable, going further out of the money provides the best opportunity to manage a winner, and the most efficient use of buying power in accounts with limited capital is in selling the one standard deviation put. Now, there are huge takeaways from this. One is it's all about strategy. Two is you can tweak the strategies over time to improve your chances across the board for all the stuff. Three, we're learning that although the returns were so much greater, for most people, they're willing to take smaller returns in return for greater chances of profitability and more management of that profitability and smaller variance in P&L.
So yes, it's true. Like personally, I was like this when I started. I didn't want to take risk when I started selling options. It's very scary to take risk at first. However, if you go on selling options that are super far out the money, like let's say around the 5 delta, so theoretically, you're going to have a 95% probability of profit on your trade. What is going to happen is that when you're going to have one loss, it's probably going to wipe out a ton of gains that you had before. So you need to be mindful about this. And honestly, it's maybe better to go to the closer at the money strike, around the 25, 30 delta, so you make more money when you win. So when there is a loss, it doesn't offset everything. But what I would add on what he said, saying that it was all about strategy, personally, I would say that it's all about trading small. And what I personally do is that each trade that I take doesn't represent more than 2% of my buying power. So that's my way of actually trading small. And when you trade small, you can really afford to manage a trade without freaking out. Because as I said before, your buying power required for one position is going to expand as, for example, your trade is going in the money and it's going against you. So you need to be able to forecast this type of thing. That's why I found that by keeping my allocation per trade of around 2% of my buying power, it's allowing me to manage my trades and be able to give time to the trade to come back in my favor.
Listen, the takeaway is just being a doer. Just do it as opposed to sitting there and being passive in the market.
Yeah, our team is not suggesting at all that it's better to take the more risk just because there was more profit from there.
No.
In fact,
Actually,
they're
it's
saying
a little bit of the opposite.
They're saying quite the opposite in that their minds, and they're all, remember, our research team is young guys.
Yeah.
Young people. I shouldn't say young guys, but just young people. And they have smaller accounts than Tony and I trade with. And so they live this. They live in the Tasty Bite world. They don't live in the world of, they don't have.
Do we wing them and how over
Do we
there,
wing them
Mr.
and how?
Big
Right.
Shot?
They live in the Tasty Bites world. And from their standpoint, this makes more sense to them to have the higher chance of success because they like managing winners. There's a much higher level of engagement. There's a significantly better sleep. And again, it makes...
And the limitations of the account, just because of its size, also suits it too.
So anyway, just throwing all this information out there, it's really fascinating. Again, I want to repeat some of the keys to this segment, then we'll move on. The at-the-money put generated 3.14 more times return, but we also saw a greater variance in P&L, 3.08.
On a smaller account, that could be significant.
And we did not chop this up and do it based on implied volatility percentile, which would further our returns dramatically in a positive direction. Okay, so we were just we didn't pick and choose at all.
Yeah, so in the end, I think that's basically ending now. What is quite important, he said something, you sleep better when you sell further out the money options. And, when I have a smaller volatility in the P&L, I tend to just sleep better, honestly. Like, don't underestimate your sleep. Like, it's important to actually be able to trade without freaking out every day and just checking your account every 5 minutes. I mean, it's an extremely important side of that business. Please make good and informed decisions. I'll see you in the next video. And in the meantime, I wish you all the best.